My first guest has been a rising superstar on Wall Street for a number of years now, says the economic data is starting to show signs of slowing, but agrees that for right now, bad news is good news. Joining me now, Citi Wealth Head of Investment Solutions, Kristen Bitterly. Kristen, welcome to the show.
Thanks for having me.
All right, so I was reading your note, and you are saying maybe a pullback is due, but it's a pullback that people want to buy.
Yeah, certainly if we see a pullback, we would buy. And I think even the pullback we saw in April, that was more of a garden variety pullback. We had 2 quarters in the S&P 500 back to back where you saw double-digit gains. So some of that intermittent volatility was to be expected. But I think when we look through the economic data, when we look at the CPI print we got, when we look at retail sales, what do we want to see for the Fed to be in a position to cut rates? We want to see a resumption of disinflationary trends, which we got a little bit, not a lot, but a little bit in terms of that trajectory. And then we do want to see a softening in some of this data, whether that's a softening in the labor market or actually within areas like retail sales.
So you're in the how many rate cut camp?
So right now we have priced in about 3. We still think we could see 3 rate cuts. And I think it's important to note, this has been our belief the entirety of this year. So we started 2024 thinking that we wouldn't get the economic data that we needed for the Fed to confidently be able to cut rates, at least until the summer months. Right. So we thought the first rate cut would be in the summer months. We're sticking to that, and we think we could see upwards of about 3. Yeah, I think we could see that. I think that's on the table.
Is it better overall for a stock market rally to be based on a strong economy or a weak economy and Fed accommodation?
So I think the one thing that we have to look at in terms of, we're not talking about a weak economy. We're just talking about
economy.
A weakening, because when you look at the overall economic data, whether that's employment, when you look at some of even the manufacturing data that we've seen, it's still relatively strong. We're just seeing, it's not contractionary, it's just a deceleration. And so I think the main thing that is driving this market, of course, the way the market is reacting to rates is very, very extreme, but I also think it's based on fundamentals. One of the big trends this year is a broadening out of that earnings story. Earnings troughed in the U.S. market in Q3 of last year, and we now anticipate for full year 2024 about 8% in earnings growth. So that's a promising sign of an equity market.
Although the irony is, the street always has a big number. The market rallies on that number. As we get closer to the actual release, those numbers, the consensus drifts. Then we beat the lowered number, but we went up. Anyway, I want to talk about the consumer. Walmart out, obviously, that would be perhaps the best proxy. U.S. sales, about the same, but ex-fuel, we saw a big decline, right, in the pace, 3.8 versus 7.4. Transactions were up, but that's because your average ticket was flat. So when Walmart doesn't have any pricing power, plus we know that more well-off families are shopping there, what is this telling you about the consumer? It's a consumer on borrowed time, in your opinion?
So I think what we learned from Walmart's earnings today was really, 2 things stood out to me. One is this trading down. So kind of looking at who is shopping at Walmart and whether you're really kind of entering into middle and upper income consumers, which we saw. I think the other interesting trend, too, was grocery sales. So moving into grocery sales, does that say something about services? Does that say something about people not going out to eat as much and actually now cooking at home? And so that could obviously drive some of the economic data. But again, I go back to this. We're coming off some pretty resilient and strong levels. Seeing a little bit of softening isn't necessarily a bad thing. And then if bad news does become bad news, that's where you enter into a buying opportunity.
Second half 2024, some of your notes historically, defensive outperforms cyclicals, U.S. outperforms international, rates outperform credit. You have a lot of folks out there, though, who really want to buy cyclicals and always want to buy international, particularly now because emerging markets, for instance, have underperformed so dramatically. Try to stick with history?
So this is actually history going into an election year. So this defenses outperform cyclicals, U.S. outperforms international, rates outperform credit when we see elections. So what do we see in a typical election year? Because this is obviously the #1 question that we're getting. You do see some volatility really around September, October, and then you tend to see equity markets trend higher. And so the way that we're positioning our portfolios right now, a couple of areas. One, this broadening out of earnings. So we like the S&P 500 equal weighted as opposed to market capitalization weighted. We also like some of the mid-cap space where you see profitable companies that are poised for growth that can see this turn in earnings.
Is there an ETF that captures that, though?
Yeah. So when you look at a great proxy for mid-cap, you can look at the S&P 400, 600, but specific because they have those profitability filters. So look at the ones that are for growth.
Okay, great. Great stuff.
Great. Thank you so much. Good to see you.
You too.